Very pleased to welcome back to the show Aaron Dunn. You know him from Keystone Financial. Very glad to have him with us again. Aaron, thanks for finding time on the weekend. And, you know, the question hasn't changed, despite the fact I was just talking to Kyle Green about this. We're seeing an edge up in U.S. interest rates. Certainly nothing sufficient to really satisfy people's needs and wants for a better yield on investment. I mean, what's this environment like for you right now?
Well, the environment, it really hasn't changed that much, and like I say many times to my clients, we've seen this cycle come back and forth over the past 6-7 years, where interest rates start to go up. People, you know, either get excited about that or afraid of that, depending on what side of the fence they're on, and they start adjusting their investment strategy based on where they think interest rates are going to be a year from now, and we just have not been doing that. It really does not matter what happens with interest rates over the next couple of years with us. We are looking for profitable businesses that are growing, that are paying an income yield or a dividend, but that are growing that dividend. And that's something that a bond does not do. It's when you purchase a bond, generally it's what you see is what you get. You're going to get that small little income coupon, and it's not going to grow from there. So we are investing for yield, but we are primarily, outside of the yield, outside of the dividend, what we are investing in is a solid growing business, and that's what's going to generate the investment return for our clients and for other investors. So that's what we're focused on, and we're still seeing opportunities out there. They're finding great opportunities in this market is not always easy, but they always come up because things always change, investor sentiment changes, and there's always opportune periods of time where you can find high-quality companies, and you can get those companies at a reasonable price, and that's what we're continuing to do. So we continue to be optimistic.
Yeah, one of the things, by the way, you guys have coming up is a do-it-yourself stock investment seminar. You know, and you're talking about how people literally, and whether they ultimately do it themselves, it gives them the tools to kind of think about about their investments. And I'll just remind people, it's coming up on April 4th at in Vancouver at UBC's Robson Square, and you're also doing it in Calgary at the Canoff Conference Center. Yeah, that's correct. Calgary on April 11th, so the following week. And so I mean, this is the kind of thing that you're going to be dealing with, though, is what I'm getting at here, is that at least, as I say, whether you end up doing it yourself, you need to be armed with some of the questions and what you'd look at. So one of the ways you're dealing with, potentially, a bump up in interest rates, I mean, as I say, we've had this huge, whatever number of years it is, 35-year decline, is by finding growth stocks. You're not worried about being in things, so you want your dividend, rather, to be able to grow, as I guess was what I'm saying, to compensate for that change in interest rate environment.
Yeah, exactly. And I mean, one way to look at it as well, a way that we look at it is you're getting a nice yield from a stock, but if you're holding that stock for a long period of time, inflation would eat away at the value of that dividend if it's not growing. So, we want to see at least compensation for inflation, but in most of these cases, the companies, these growth stocks that we're investing in, we're getting more than just inflation. We're getting a business that's actually growing value and then sending that value back to shareholders in the form of a dividend. But I'm glad you brought the investment seminar up, because it's something that we are really excited about right now. It's people have been asking us for this for years, and now it's finally happening. And what we're going to do is we're going to break Keystone's investment process down into very simple and easy to implement principles and teach people things like how many stocks to own in the portfolio, what to look for in a stock to buy, signs that you should sell, and signs that there are certain situations that you should avoid. So it's going to be very interactive as well. Lots of opportunities for investors to ask us questions and clarify details. And we're encouraging people to even send in companies that will, or bring in company names, and we'll do analyses right there on the spot to just show people how we break companies down and how we look at them. And the whole idea here is that we want to empower people. We want to give them the tools so that they can take more control over their own financial future. And you don't necessarily have to be a professional analyst to do that, but in investing, a little of the right knowledge goes a long way, and that's what we're going to help people do.
Let me just, I'm going to give you a chance to give me an example of this, because I was looking back on stuff that you've recommended on Money Talks and at the World Outlook Conference. So I'm going to give you one name. I love the company, Brookfield Infrastructure. The symbol, by the way, is BIP, Bob India Peter.UN. Okay, so I looked at my notes. You recommended this, I think it was about 5 years ago, right around now. It was March, I think, of 2011. Stock trading, let's say about $15. Okay.
Yeah.
It pays its dividend. It's done well. I want to know, do you get out of that stock? Well, first of all, what is the current price? Something like $50 right now?
Yeah, $50 is the price right now. You're right. We recommended it in 2011 at just over $14, about $14.50 a share. It depends on what is driving the share price appreciation. In the case of Brookfield, what's been driving it is success in the business, is growth in the underlying cash flow and in the dividend as well. So if you look at the company today, it's trading at a valuation of just over 14 times cash flow. So it's not super cheap, but it's reasonable because it's a company that it's a highly stable business, global infrastructure, long-term contracted assets with inflation indexation, and the valuation is actually not much more expensive than when we originally recommended it at $14.50, and it's really in line with what it's been trading at historically. But I did some calculations on this, Michael, and I've been doing this with some of the companies that we've had under coverage for 5, 6, 7 years. And over the 6-year period, Brookfield has actually paid investors $6.88 US in income distributions. So we recommended it $14.50 Canadian, and investors that have owned it over that period have gotten $6.88 US back just in income distributions. On top of that, the share price or the unit price is up about 250%. So, but to answer your question, they just keep investing back in the business and they keep growing free cash flow, and we like it. Not for something to buy for the next 2 months, but if you want to buy something like this and hold it for the next 2 or 3 years, we think you're going to continue to do really well in the same.
Yeah, it's really interesting because that's one of the challenges for people. Obviously, this is simplification, but it's what to buy, but when to sell. And that's why I found that one interesting, because I'm looking through this and I'm thinking, there's a tendency to say that has gone up so much, I got to get out of that thing, lock in the profit, and I'm assuming that we don't have some special circumstances like you need the money for something desperate. But it is interesting to hear you say that the valuation, when you looked at the quality of the business, the size of the business back 5 years ago, but it's grown commensurate with the share price. So the valuation isn't much different.
No, that's exactly it. And that is what you need to. That's two different situations. You can have a situation where a company is up 250%, and that's driven by a valuation expansion. So maybe earnings have grown a little bit, but really, your price to earnings valuation is what has moved the stock higher. In that situation, that's where you really have to look at that and say, okay, the share price has moved up a lot. Maybe it's now time, depending on the valuation today, that I should take partial profits at least, or all profits. But if you're looking at a company where the share price appreciation is driven mostly by growth in the underlying business, the valuation is still reasonable or attractive, and you still see a solid growth profile going forward, you don't necessarily have to take profits on a company like that. You can keep you can keep holding it. In some cases, keep buying it. You don't want to let one company account for too much of your overall portfolio, but there's no reason if a company is continuing to succeed in what it's doing, there's no reason to sell it based on the fundamentals. And these are exactly the things that we're going to go over at the workshop as well, is to teach people how to look at different situations and determine what is the best step to take in terms of buying or selling a company.
Well, it sounds like just a great idea, by the way. I'm obviously I wouldn't be doing this show and wouldn't do the World Outlook conferences if I wasn't big on education that way. But all you have to do, by the way, is go to keystocks.com, www.keystocks.com, and they have a button you can click on there for the do-it-yourself stock investment seminar, which is, as I say, I just think it's really valuable information. And Aaron, you know me, this is where I say you got to bring a young person with you. God, this is, I hear so many times, you have no idea how often I hear people saying, I wish I knew this 20 years ago. I wish I knew this 30 years ago. It's never too late to learn it, but man, it would be helpful if you got it early.
Exactly. Keystone's been doing this for 20 years, so why not benefit from that experience, from the things that we've learned over 20 years? And that's exactly what we want to do. And it's great to see young people at these conferences and at these workshops actually learning, and it's a great opportunity for them.
I got to take a break here. I'm going to come back. I'm going to give you a warning, Aaron. I got a couple of other names for you. One name also that you recommended 6 years ago, and I got to get an update on that. Again, I'm still looking about, why did you buy it, but why would we still keep it, or why would we buy it today, if at all? I'll do that with Aaron Dunn when we come back right here on the Money Talks Network. You're 17 minutes away from Ozzie Jurek joining us, and I've got a test question for you because I don't think you're ever going to get this one. What was the strongest housing market in Europe in 2016? Strongest housing market in Europe. As I say, you start guessing now, I don't think you're going to get it. Joining me on the line right now, I've got Aaron Dunn, Keystone Financial. You can find them at www.keystocks.com. Aaron, I want to ask you about a couple of other situations. One, for example, the Exchange Income Corp. First time I saw you recommended that was on this show 6 years ago. I'm choosing ones that are March ones, but 6 years ago. I think the stock was about 14 and a quarter. My goodness, has it ever shot up since then? It's $39 when I looked on Friday.
Yeah, absolutely, and it's a company that we still like going forward too, because it's another example of a company where share price appreciation has been driven largely from growth and underlying free cash flow, and the valuation has become more expensive since our original recommendation, but it's still very reasonable, about 12 times free cash. And I did a calculation on this as well, Michael, and we recommended it. So 2010 is when we originally recommended the company. It is paid out at, like you said, $14 and change. It has paid out $11.93 in dividends over that period of time. So basically, almost paying back its purchase price. And the reason why that's important to talk about is because it really shows the power of a good dividend growth story. It really shows, and it shows that this is a company that is actually concerned about giving value back to their shareholders. So if you're somebody who's been holding the stock for that amount of time, you're basically playing with the house's money right now. And you still have a company that's growing, that has a solid yield, about 5.4% today, and they're continuing to grow their dividend on an annual basis and do things like reinvest back into the company to generate great organic growth and to look for accretive acquisitions to roll into the company and grow the dividend further. So it's one of those names that we liked it 6-7 years ago. We continue to like it today. I would take a 2 to 3 year outlook on the company, not a 6-month outlook, but it's something that we continue to like for sure.
I got to come back to this though. It's like reiterate why you wouldn't sell it today. I mean, why when you buy it at $14.50 or something, and now it's $39. I mean. Why, is that a buy today, or do you think it is a buy, or is it just a hold, or is it, hey, grab your profit and run?
No, it's a buy today. It continues to be a buy today. For people that are looking to hold it for 2 to 3 years, there's going to be some volatility in the interim. But really, it comes down to valuation. So you look at a company like this, it's paying a nice yield, it's growing that dividend, very nice payout ratio, about 60% right now. Like I said, 12 times free cash flow valuation. Record performance last year, record performance the year before. So you compare that. Forget about what it's done in the past. The past really is the past. You look at what the story is today, and you compare that to what else is available on the market. And when you do that, it compares quite favorably, and not just relative to what the market is offering today, but relative to what you typically see in terms of price to cash flow valuations for companies with this type of a growth profile.
What kind of yield does it still have?
It's 5.4% today.
Okay. Is
what it's yielding. So still a nice yield, and they've increased the dividend twice over the last 12 months. It's up about 10% over the last year. So we expect that to continue over time as well. Like I said as well, 60% payout ratio, so reasonable payout ratio. They're not stretching that free cash flow to pay the dividend, and that's something else that we really like to see. But this company, the ultimate strategy of this company is to make acquisitions of profitable businesses for reasonable valuations that they can roll into their company, and that's what they've done to drive the majority of their growth in the past. You're going to have times where it's more difficult to make large acquisitions because of pricing out in the market, and I think that's something that we're dealing with right now, but they're still making small acquisitions. They're still investing back in the business and growing, and there's always that potential, and eventually I'm very confident that it's going to happen. There's always that potential that they're going to see that big elephant to acquire, and that's going to mean a big step up in free cash flow. So it's the type of story that we like to be with.
Exchange Income Fund, by the way, Income Corp, rather, EIF is the symbol. Okay, you got about 2.5 minutes. Give me something else that you're looking at these days.
Okay, so I'm gonna do something a little different. It's Meritage Hospitality Group. The symbol is MHGU. This trades on the OTC bulletin board in the U.S. for about $13 per share. It's from our U.S. growth stock service, and it's part of our Discovery portfolio. So these are high growth but higher risk microcap stocks. Why do we like the company? Very simple business. They own a network of 200 Wendy's restaurants throughout the United States. The strategy is to acquire new restaurants where they can increase sales through renovations and profitability through integrating into their IT system. In 2011, they did a 5-year plan to grow the number of restaurants from 90 to 150. They exceeded it, and over that period of time, they more than doubled their operating earnings, and the share price increased 450%. So now, starting this year, just this year, they've initiated another 5-year plan to bring the number of restaurants to over 300. And just a month into this plan, they've already signed agreements to acquire 67 new restaurants. So we're very confident that they're going to exceed this target once again. They do pay a small dividend. It's not really an income stock right now, but we're also looking forward. They've increased the dividend, and I see that continuing. So I'm going to reiterate, it is certainly higher risk. It is an OTC company, and it's quite thinly traded, but simple, easy to understand business model, strong profitability from current operations, visible growth plan, and a great track record for success. So profit margins may fluctuate a little bit depending on when they make investments, but it's a story that we like, and it's something that if you're gonna hold it for 3 to 5 years, then we think that it's gonna produce another excellent return for investors.
Yeah, but I love the way you're doing that, though, and you do that in your service, too. You talk about the risk. I mean, every time anybody thinks of making an investment, they got to say, what kind of risk is this? And you just said, this is higher risk. You know, something else could be conservative, but I love that approach to you. Aaron, I want to thank you for taking the time, and I'll remind people that you've got the big Do-It-Yourself seminar coming up, both in Calgary and Vancouver. Vancouver, it's April 4th. And Calgary, it's April 11th. For information, just go to www.keystocks.com, www.keystocks.com. Aaron, thanks for finding time for us.
Thank you very much, Michael.